Hello and welcome to this ABB Enterprise Software presentation, Use Financial Transmission Rights and Auction Revenue Rights to Hedge Financial Risk and Enhance Power Market Models. This presentation will last about 45 minutes with 15 minutes for questions at the end. Please ask your questions in the Ask a Question box on the right side of your screen. ABB Safety Moment: if you're joining this presentation from a mobile device, please ensure that you're able to stay aware of your surroundings and use hands-free devices where appropriate. If you're joining from an office or a conference room, please note the emergency exits. This presentation is being recorded and will be shared with you for future reference. And now I'd like to introduce Yang Song, Senior Advisory Consultant with ABB Enterprise Software. Yang, you may now begin.
Yeah, good day, everybody. Welcome to my presentation. I'd be happy to give the presentation with the topic of using FTR ARR to hedge financial risk and enhance market models. So in the past few years, extreme weather events, volatile fuel costs, generation transmission outages, all of those factors expose utilities to substantial financial risk besides operation challenges. The ISO designed financial tools such as ARR and FTRs for market participants to hedge against transmission congestion risk. In this presentation, I will walk you through the mechanism of ARRs and FTRs and the techniques of using FTR ARRs to protect utilities or marketers from financial risk and build a robust business model. So I will start from a brief introduction of my background, and then I will introduce the concept of ARR and FTRs and the mathematical models, and I will go over the value of ARR and FTR in the U.S. market, and then in the last I will talk about the ARR and FTR strategies. So a little bit about myself. I have a PhD degree from Georgia Tech, and then I have a research background in IEEE. And I worked for independent power producers, load serving entities, and financial institutions. I interacted with multiple ISOs in the past, including PJM, MISO, ERCOT, New England, New York. And I'm an expert using the following tools, including PERMA, the U-Plan, Laser, PERMA. So I worked as a trader and consultant, so that gives me a different perspective when analyzing a problem. As a trader,
Presentation mode is now enabled.
So I deal with different kind of emotions, win or lose. So I focus on the executability of our strategy, not just from a fundamental point of view. And I look forward for future trend, standing at current market conditions. So as a consultant, I focus on the details of the different perspective of the modeling. I try to find out the strategies from a wide area of information, and I look at a problem from different angles, top to bottom and bottom up. So for a fierce line, from different angles, it may look like a cute squirrel. And I communicate with different departments in the organization, such as risk controls, credit, regulations, and management. And to communicate my strategies and fundamental ideas to people with different backgrounds. So now let's start with the concept of ARR and FTRs. So what is FTR and what is ARR? How are they related to each other? ARR is auction revenue rights. It's hosted by ISOs on an annual basis. It's free, but it has to nominate the FTR pass. It will generate either revenue or charges based on annual FTR auction. Now we can see the FTR name popped up here. So that's how ARR and FTR link together. So for what is FTR? FTR is financial transmission right. If you can receive FTR in either monthly or up to 3 years out FTR auctions. hosted by ISOs. The revenue comes from day-ahead market, which is only the congestion components. The risk of ARR and FTRs is you will get either a revenue or charges based on your nominations. The FTR revenue will come from day-ahead settlement. It's a difference between source and sink congestion components. That's how they calculate the FTR revenue. The cash flow of ARR and FTR. Hold on, sorry. Go back. So the cash flow direction is from day-ahead market. Oh, what's going on? From day-ahead market to FTR market and then to ARR market. And the only FTR annual auctions revenue will go to ARRs. The profit of ARR is for load and transmission, load server entities and transmission service. The FTR is for mostly generators and financial institutes, and financial players is mostly participating in the day-ahead real-time derivation, that kind of virtual market. So now I will go a little bit deeper into the ARR mechanism. So I tend to look at ARR from both physical and financial perspective. On the physical side, ARR is a collection of the source and sink pairs. In stage 1 allocation, a participant can nominate generators as a source and their load zone as a sink. In stage 2, you can nominate anything in the footprint as a source and sink to your load zone. A simultaneous feasibility test has to be passed to ensure available transmission capability cover ARR nominations. The source generator sink as a load. The network continuity conditions has to be enforced. Upgrades and outages need to be included in that model. If it's not feasible after the SFT, then all the nomination will be prorated according to their megawatt nominations. At the end of the allocation, the final results will be forwarded to regional transmission expansion plan, and then the PGM, for example, they will use 10 years of load growth to see if there's any necessary transmission expansions to according to the ARR nominations. The financial side, so like I mentioned earlier, it's either going to be an entitlement or obligation. It's based on the LMP from annual FTR auctions. Allocated in a two-stage process. Stage 1, Stage 2. Stage 1 has two A and B stages. So 1A covers base load, 1B covers peak load. And Stage 2 will be 3 rounds, allowing any source to be native load to the native load zone. Interestingly, some company they have a more advanced strategy. They can convert ARR to FTRs and then settle in day-ahead if they have a good fundamental view, or they can reconfigure their ARR by acquiring alternative FTRs or doing some OTC trading as a proxy hedge. So what is the mechanism of FTR? It's very similar to ARR. On the physical side, you will have a collection of source and sink pairs. Source can be zone, hubs, interface, generation, or load. A sink is the same. So you also need to pass an SFT test, similar to ARR, but the difference is that you have to do optimization objective is to maximize the quoted base value of a set of SFT satisfied FTRs. At the end of the auction, the highest bid-based combinations of FTRs satisfying SFT will be awarded. On the financial side, FTR can be an obligation or entitlement. The revenue is based on the day-ahead market congestion components. it can only be allocated in the auctions. The auction is held either monthly, annual, or long-term. You can also reconfigure your FTR positions to alternative FTRs, or you can do some OTC trading. For the FTR market, there is a strict credit requirements. Also published formulas to calculate the credit requirement to participate in FTR auction. So by further optimize the credit requirement, you can possibly lower your requirement and obtain more positions. So the next topic is the market value of FTR and ARRs. The chart to the left is a summary of the PGM ARR revenue in the past 4 years, downloaded from PGM website. So we can, by looking at this chart, we can see a couple of issues. The big picture is we have a contango trend since planning year 13-14, so the congestion tend to increase. We have a little bit of reversal trend starting from the current planning year. On the zonal level, there are a lot of volatilities. For example, AEP, BGE. Take BGE as an example. Starting from planning year 13-14, the ARR revenue for BGE zone doubled into planning year 15-16, and then doubled again in planning year 16-17. And if you look at PPL zone, the revenue went up from 9.6 million in planning year 13-14 to 15.7 million in planning year 15-16, and then dropped to 2.6 million in planning year 16-17. So that's huge amount of changes year over year. There's the fundamental drivers behind that. So it's driven by commodity prices related to extreme weather events. It's also correlated to transmission upgrades and outages, some generation retirement, and some environmental rules. So that brings up challenges to the market participant, especially low-serving entities. So in this environment, low-serving entities may need to deal with more competitive low-serving pricing, and then more dynamic ARR nominations. You may not be able to use the same ARR nomination as you used last year because you may suffer a obligation charge. Some intermediate hedging may become necessary because from year 1 to year 2, your asset, if you look at ARR as an asset, the value will change dramatically if you don't do any hedging. So you will just sit there and observing the trend. So now let's look at the market value of FTRs. So I download all this data from ABB Energy Velocity Suite for all the ISOs in the US for the past 4 years. On the column headers, auction column is the auction value, meaning the investment of all the market participants. And settlement is the revenue received in day-ahead market. And the profit is simply the difference between settlements and auctions. So we can see from this chart in planning year 13-14, the return from day-ahead market is much higher than the investment, driven by the extreme weather events. And then in the following 3 years, the investment in FTR market doubled, almost doubled. And then the return goes down because of the high investment. And especially in planning year 15 and 16, we have a pretty mild weather, so that's why we see a small loss in the FTR market overall, first time in the history. The good part is, starting from planning year 16-17, we will start to see a small uptrend. The risk and rewards tend to balance each other, so we will go back to a small contango trend. So this chart shows the investment and return and profit only for the IPP and LSE. IPP means independent power producer, LSE the load serving entity together. So we can see they constitute a small portion of the FTR market compared with the previous slide. And we can see active hedging activities in the by utilities in PJM, MISO, New York, and ERCOT. There is a potential growth margin in CAISO and SPP. And the hedging cost for utility, that's the challenge they are dealing with, is the cost goes higher starting from 2014. So some of the utility increase their investment because of the extreme weathers and just to follow the risk. So that's here. So in order to look down to more details, so I downloaded the top 10 and the bottom 10 behaving FTR paths. So the most profitable FTR path in PJM market is on the it's highlighted in red color. It's mostly from utility hedging on the nuclear unit on the western side of PJM. I can see these hedging are driven by a combination of fundamental views and some fixed strategies. On the bottom side of this chart is the losing FTR strategies. It's mostly, I can see, it's possibly driven by chasing opportunities and risk following from the polar vortex event, and also following some historical performance of the past. It's possibly also some offsetting positions against their OTC market. So on the CAISO market, I did the same analysis. So again, the most profitable path is from the hedging activities and driven by congestions introduced by imports, and there's some price-taking hedging also. On the losing side, we can see it's mostly from single point to single point FTR paths. So I speculate this possibly from certain financial institutes doing some statistical analysis on the historical data. So a more detailed look at the IPP behavior and performance. In the past 4 or 5 years, IPP1 making constant revenue in the FTR market. So in 2012 to 2013, there is a fundamental change in the transmission network. So the congestion increased a huge amount in their territory. So they start their active hedging in FTR market. So in that direction, they make more than $130 million per year. And then in the past 2 or 3 years, the cost of hedging increased. That's why we see the profit going down a bit. For IPP 2 to 6, we can see in 2013 there's a huge amount of return for them, driven by the extreme weather events. And since then, they start more investment in the market. In the past 2 years, there's a little bit over investment in FTRs. So that's why we see a little bit loss on their side. And IPP7 to IPP12 are the new market participants or more active, become more active in the past 2 or 3 years. So they have, I can see their behavior is more fundamental driven. They have good models. So they look at fundamental drivers of the market trend, and so they trade accordingly. The summary of the value for ARR and FTRs. Our current situation can be summarized as follows. We have remaining risk premium for polar vortex. There is still fast-growing renewable energy. We are dealing with low commodity prices. Transmission grids upgrades is still many in a couple of ISOs. We see an increased investment from utilities, and there's possibility for the financial players to participate even more in this market. driven by profit or maybe relaxing of the financial regulations. For the future speculations, the market participants still need to deal with the impact of volatile commodity prices. We will also need to deal with the change of renewables. And the financial players is still going to lead to FTR market, but the utility will become more active and competitive. There's a low uptrend possibly in the FTR market, and there's possible converging behavior between ARR and FTR market and also FTR versus OTC market. So all of this will demand a more accurate production cost dispatch model to better understand the fundamentals and future trend. So in the last section, I will talk about the FTR and ARR strategies. First, I will introduce the why we need to hedge use FTR and ARRs. What's the importance? So the typical pricing node utility is dealing with. Typical pricing nodes utility dealing with can be summarized into three types. It's a generation node, or zonal node, or hub node. So between these three type of nodes, only hub is fully tradable with a very good liquidity. And zones and hubs, and also their spread, only trade a few times a month. And for the generators, there's no direct trading activity other than the FTR auctions on a monthly basis. So look at the price trend of these three types. Usually the generators is cheaper because of the congestions, and zone is much higher because of load forecast and dispatch issues. But the links between the three is very dynamic. Sometimes you can have a very high zone prices and hub doesn't move. Sometimes you have very low generator price and your hub is not moving much. So for IPPs, the typical position is for them is usually short hubs to hedge their generation position, and they will be long at their generation node. For LSE, naturally they will be short their zones. In order to hedge, they will buy hubs. However, the behavior of this hub and zone on the node on the financial market is very volatile. So the advantage of using FTR and ARR in hedging is the hedging target is not only basis and spread, but also hedge down to the congestion level. Using fundamental analysis and modeling, we can find out the drivers and the characteristics of the congestions. We will understand how long the congestion will last and what is the magnitude. Well, in OTC hedging, we can only hedge basis or spread. And the liquidity. In OTC markets, usually people will deal with very wide bid and ask, and trading frequency is not that good. Well, the liquidity in FTR market, you have guaranteed monthly liquidity, and you have also opportunity to trade 3 years out in the long-term option. The market transparency. In OTC market, is heavily relied on the broker communications. Well, in the FTR market, it's ISO hosted auctions. The ISO use mathematical models and physical limitations to generate the revenue, FTR and ARR revenues. The risk controls. In OTC market, usually it's a single direction bet, either you long or short. And if you are wrong, you want to exit, you have to pay very high cost to cross the bid ask. However, in the FTR market, you can structure your bid. You can try to buy a lot of volume at low price and buy a little bit at higher price, or you can leverage your portfolio by mixing some alternative FTRs with high impact on from the congestions. So analytical side, OTC usually relies on zonal stack model. And the FTR model, we have complex cost production models such as per mod. So now I will introduce briefly a strategy and modeling techniques based on available ABB practice and knowledge. ABB have a per mod product and also publish reference case every year. So in the reference case, the most up-to-date market information will be imported, including fuel forecast, transmission upgrades, generation, addition retirement, and some RTAP upgrades. It's all mixing together, and then we'll do some benchmark testing and adjustment. So using this reference case, we are able to forecast ARR values for both stage 1 and stage 2 allocations. For stage 1, we will find out what is the optimal ARR revenue based on per mod forecast and also compare with historical values. In stage 2, we will identify the missing constraints by comparing with ISO published ARR constraints, and then we'll do contingency analysis. At the last, we can propose additional ARRs to chase additional revenues. In the FTR model, we will start from the ARR model we just built and put in more detailed modeling information, such as all the transmission outages longer than 3 days, and all the upgrades with detailed timeline and simulations with perturbations, high load, low load, high gas, low gas scenarios. And altogether, after we run some benchmark and adjustment, we can produce both zonal basis forecast and congestion forecast. Using the zonal basis forecast, we can compare with OTC market and find out which market you can choose to better hedge your asset. On the congestion forecast, we can identify the congestion with the most impact on your basis or spread. Then we can propose FTR candidate to hedge more detail, to provide more detailed hedge to your asset. The consulting service ABB can provide pretty much covers everything in the FTR and AR market. On the AR side, we will be able to provide AR auction assistance on an annual basis. We forecast nodal level AR revenues. We will present nomination strategies to maximize your ARR revenue. And we can also provide monthly basis the AR pricing for load serving entities. We will tell you what is the competitive pricing for ARR value portion when you go to the load auction, considering your expected profit margin. We can also help with the intermediate ARR hedging from year 1 to year 2 ARR auctions. The market goes through a huge amount of dynamics. So we will evaluate your ARR assets and then forecast the nodal on the nodal level to identify FTRs or some OTC hedges to protect your ARR asset. The services we can provide for the FTR side is basis and spread forecast and hedging on the monthly or up to annual level. We use our model to do nodal forecast to identify the congestion drivers, analyze the impacts for congestions, and structure direct or indirect hedges. Also for the financial market participants, we can provide further support to give fundamental views on the entire market and also down to the nodal level. We can assist in your FTR portfolio management to find out your risk and assist in your trading strategy. So if you tell me a trading strategy, I can help you to evaluate your strategy to find out your risk and the reward potential. So that wraps up my presentation. So I'll be happy to answer any questions you may have.
Thank you, Yang. So we've entered the question and answer period in this presentation. We'd like to know your questions, and Yang is very well versed in the topic. Please let us know if you have questions. Enter them into the Ask a Question pane on the left side of your screen. I've also launched a survey in the presentation window, and we'd appreciate your feedback. Your feedback is confidential. So far, I've only received one question, Yang, so I'll go ahead and move into that while people are working through the survey. The question is, and it references a couple of slides, so it says, When you compare slide 12 to slide 11, you see the returns from independent power producers and load-serving entities are pretty low compared with other market participants. What are the reasons for such low returns from independent power producers and load-serving entities, ARR and FTR positions?
Well, there are many drivers for this. First of all, the FTR market is still led by financial institutes. They have the most amount of credit and financial capabilities. So second driver is utilities. The goal of utility in the FTR market is to hedge their assets. It's not purely profit-driven. It's more risk-avoiding type of target. But for the financial institutes, their objective is to maximize their profits. So when they look at a fundamental model, they will look at what is the best risk reward. Well, the trading for the utilities are not always the best risk reward trade, but they have to do it to hedge that risk. And also the financial institutes, their trade covers the entire footprint. They can go down to any corner of the market, any single node bus, but utilities usually only focusing on either their generator node, load zone, or hubs. There are some degree of alternative hedging they have done, but there's still a lot of room to go. That's my answer to this question. Slide 10. Oh, okay. I can answer this question. So we can see on slide 10, it's the ARR value of PJM market in the past 4 years. So what caused the fluctuation and the different observations of what changed over time? So there are a lot of changes from starting from planning year 13-14 in a couple of zones especially. So the gas basis is very volatile starting from planning 13-14, especially on the eastern side of the PJM market. We see very low gas prices on the M3 basis and Transco pipeline, also Dominion South, and so that caused the dynamic to change. So a lot of congestion start to increase, especially in the BGE PEPCO zones. That's where the marginal coal unit is. So those coal units will start to run at as a marginal unit, and the gas unit on the eastern side, like PECO, PPL, they become the source of congestion. That's why you see their ARR revenue goes down dramatically. Well, in planning year 14-15, we had a polar vortex event, so that's why we see a lot of increase during these 2 years. So the revenue goes up because of the hedging activities and profit chasing activities. For the COMET zone, it's a different driver. It's because of imports from MISO and some new generations online and some transmission outages causing the congestions. So, but going forward, I think the dynamic will change again in the next year because a lot of these drivers will change. So any driver change will cause dynamic change in the system. So that's why we shouldn't look at historical data for our future trade. That's all.
Okay. The next question is, do financial traders involve in more FTR and not ARR? Do you have both? Do you have to do both? Or can one participate in just one?
Well, I guess that depends on how you define financial traders. For financial institutes, most people deal with FTRs because ARR is only for load serving entities and transmission service providers. So only those two type of market participants can be allocated with ARRs. Well, on the hedging side, that's different. If you want to hedge your ARRs, you may rely on your financial traders to structure a good strategy involving FTRs. One can participate just one. Yeah, for ARR, you can only participate by LSEs. FTRs is open to everybody. So everybody with a good credit line can participate in the FTR market. That's all.
Okay, next question is, can you expand your trading risk evaluation service?
Okay. Trading risk evaluations. I got this question when I was working as a consultant or analyst. So I was working with a risk management group. Because there are so many pressing nodes in the FTR market, it's not very possible to create a trading curve for all of those nodes. So I think the pro mod or some complex model is helpful. You can forecast your price on the nodal level and combine with the option value, so you have a pretty good idea of the volatility on the nodal level. The ISO, they have options on the monthly basis. The option usually covers not just the per month, but also month forward and maybe even quarter forward. So you have a pretty good idea of the risk, the range on the nodal level. And then together with ProMod and historical data studies, you have a better idea on that. So we definitely will provide that kind of service. We can customize our service to your need. That's all.
Okay. And the next question is, can you please re-explain slide 11 in terms of noticing costs increasing and margins, etc.?
Okay. So at this slide, starting from 2013, so the investment was made in the FTR market. If you look at the column option, it's $1,800 million altogether for all market. That investment is accumulated investment across all auctions in the planning year 13-14. So almost at the end of that planning year 13-14, we had extreme weather events, so nobody can forecast that. So all of a sudden, the return on all the FTRs increased huge. So at the end of the planning year, which is May, so the overall return from day-ahead settlements is over $5,000 million. So that profit, you subtract these two numbers, you get 3,600. So then in the following planning year, all the market participants, we notice this profit margin, either utility or financial institutes, they come in to invest in this market. So the investment is $3,500 million, which is a little bit lower than the return, but it's doubled compared to 1,800 in the prior year investment. So and after planning year 14-15, the return from FTR market from day-ahead settlement is $4,400 million. So you still see a profit, and then market will keep chasing this return year by year until planning year 15-16. You will see a loss because of the weather is so very mild. And then from 16-17, the investment goes down compared to 3,300, it went down to 2,600. That's when we start to see a little bit return in this year. Okay.
The next question, devoid of trading around physical assets, is an FTR play strictly speculative?
Okay, trading around the asset. Okay, let me go to that slide. So the FTR trading around the asset. Speculative, well, it's not entirely speculative. Well, it depends on the company's trading style. So some companies, they have some internal policy they need to hedge just no matter what happens, they need to hedge certain percent of their asset. Some companies, they are more advanced or, more complex. They have fundamental models, and traders, they are willing to take additional risk. So they run the models and get a feeling of the market trends, and they do their direct or indirect hedging in the FTR market. So there are a couple of utilities that are doing that. So they look at the congestion close to their asset. There's no way you can hedge that in OTC because OTC only trade hubs and zones. So they go to FTR just to hedge the congestion cost for that congestion close to their asset. So in that sense, it's kind of speculative, but still within their boundary of asset. So utilities usually don't go to any press node to trade, and they will only look at pretty much the congestion nearby their asset. That's all.
Okay, the next question. Can you please step through slide 19 and steps that you go through with ProMod and why?
Okay, the ProMod is a complex production cost model with transmission constraints. So it does already dispatch and unit commitments, same way as ISO is doing every day. So it mimics what ISO is doing on an hourly basis. So with accurate input information, we are expecting to get accurate and the reasonable output from our model. So the steps in setting up a ProMod model is a group effort. We have many experts in our group. They are tuning the model, collecting information, updating on a daily basis to make the model more accurate. Then we do benchmark and backtesting to make sure all the data is reasonable and matching our expectations. And then using that model as a base case, we can go step forward to ARR evaluations. So we will generate ARR forecast for each ARR pass. We can generate on the nodal level what is the expected revenue and what is the congestion behind it. And then two steps further is we go from ARR model, we go to FTR model. So in that case, we'll collect even more detailed information to include more outages and more perturbations, more scenarios to find out the risk boundary of the asset or some trading portfolios to find out what is the risk drivers and forecast the prices on zonal and nodal congestion level. That's all.
Okay. And it looks like we have no other questions at this time. Some people have expressed thank you for great answers. And unless I see any more questions come through, I think we'll go ahead and wrap up. There is a Contact Us tab in your presentation. Our contact information for email, phone, and our website is available there. You can contact us if you have further questions that way. And like I said, we will be sending the slides and the recording of this presentation for your future reference. So at this time, I'd like to go ahead and thank you all for joining us today. It's been a pleasure to make this presentation for you, and have a great day, everyone. Thank you very much.
Thank you very much.